When you think of investing, the stock market is probably one of the first things that come to mind because you can make a ton of money, you can become fabulously wealthy, or you could lose all your money and become broke. Now, in order to hopefully prevent the latter, keep watching because in this video, I walk you through what you should know before investing in the stock market. So stay tuned. When people think investing, the first thing that comes to mind is the stock market, and rightly so, because over the long term, the S&P 500, which is an index of the biggest 500 companies in the US, has provided on average an 8% return. Folks, this is the average over a 90-year period. So when it comes to saving and growing your money for either retirement or just looking to meet other financial objectives in life, investing in the stock market's likely going to be a big part of the strategy. So, what do you need to know? First things first, hopefully, if your company offers a 401k, you're already investing there, which gives you exposure to the stock market. Now, if your company doesn't offer a 401k, there are other options for tax advantage retirement accounts like a traditional IRA or a Roth IRA. Now we'll go into detail with those, but you can go into the description below. I'll provide some links that will elaborate and explain that a little bit further. But you'll want to keep watching because a lot of what I'm about to say will still apply. In a 401k, you're often given a few different options of buckets to invest in. Now each bucket has a different investment profile, usually depending on how far you are from retirement age. Now, the farther you are from retirement age, the more likely you'll want to explore a more aggressive investment strategy, which just means that whatever bucket you put your money into, that bucket is going to have a higher percentage of money in stocks versus something less risky like bonds. Now, we also consider it more aggressive because stocks tend to be a little bit riskier because in any given month or year, the stock market can be up dramatically or it can fall off a cliff. But again, over the long term, the market does return about 8% on average. Now, if you're closer to retirement age, which is 59 and a half, you'll be less inclined to want to have a lot of investment in stocks because if the market happens to dip right before you retire, you don't have as much time really to recover. And so effectively you're withdrawing from a smaller pile of money. But if you're a long way out from retirement, you'll want to choose a bucket that's more invested in stocks so you can maximize your return over that long period of time. And if the stock market happens to dip at any point during that long period of time, well, you've got plenty of time to recover and then continue to grow with the market. So when you select that bucket, what you're really buying into is either a mutual fund or some index fund. Now, easiest way to describe a mutual fund or index fund is, let's say, instead of you personally going out and buying a whole bunch of different stocks yourself, you can invest in a fund who takes your money and pulls it together with a bunch of other people's money, and they in turn invest in hundreds of different stocks. So what you're getting with that is broad exposure to many stocks and the market as a whole, and the goal here is that your returns should approximate the average return of that particular market, or hopefully do even a little bit better than that. Which brings me to my second major point, which is if you're looking to invest in the stock market outside of your 401k, well, you've got a lot more options. Like in a 401k, you can actually go out and invest in these funds on your own. There are many options out there from investment firms like Fidelity or Vanguard, Charles Schwab, just to name a few. And each of them offer a variety of funds that target maybe specific industries or company sizes or even countries. You name it, there's probably a fund for it. Any way you look at it, the best bet for most people, the general investor, to get into the stock market is to go into it through an index fund. This is because investing in the stock market has some risk associated with it, and when you invest in just one company, your risk is substantially higher. If that one company does not perform well, you're out of luck. Of course, the opposite can happen. The company can perform very well and then you're in good shape. But the idea here is that you want to invest in more stocks than just one, because you want to be less reliant on that one company to perform well in order for you to get the returns that you're looking for. This in turn makes the overall investment strategy less risky. And in an index fund, that allows you to do exactly that. Instead of being invested in just one stock or even 5 stocks, you're effectively invested in hundreds. Now, last note on index funds, I ordinarily recommend those over mutual funds. And when I say mutual funds, I'm referring more to actively managed funds. And really what those are is you've got a team of people at the company or at the investment firm strategizing and making decisions as to when to enter a stock position or when to exit a stock position. So there are a lot of transactions going on. And if you were to look at some of these funds, you'll notice that there are management fees, and you'll see them in the form of an expense ratio. And those for actively managed funds can be anywhere from 0.5% all the way up to 2.5%. And those management fees are what you pay for being invested in that fund, with the hope and expectation that the fund and the decisions that they're making are good enough to outperform the market average. However, it's been shown time and time again that over the long term, actively managed funds typically underperform index funds, which are minimally managed. There are far fewer transactions, and the goal is purely to track with the market as a whole. And because there's less management involved when it comes to index funds, that means a lower management fee for you and ultimately a higher return. Now, with all that said, if you really wanted to, you could invest in specific companies or specific stocks. The rewards can be quite a bit higher, but the losses can also be quite a bit higher as well. Now, I won't be covering any of that in this video. There will be many more videos that I post in the future because there's quite a bit more to unpack when it comes to investing in stocks. But for this video, here are your 3 main takeaways. First is the stock market carries a degree of risk when you decide to invest in it, but over the long term, it generally provides the best returns for the risk that you take. Second is if you do want to invest in the stock market, generally, the best bet for most people is going to be an index fund, which gives you broad exposure to the market. Third point is if you do want to invest in individual stocks, you certainly can. There's a greater reward, but there's also a greater risk as well. And if you want to learn more about that, make sure to subscribe down below because there will be many more videos I post on exactly that subject. Folks, that's all I had, and one last thing I'll leave you with is anytime you hear investment advice from anybody, just make sure to do your due diligence, do your research. And if you have any doubts or questions, further questions, do consult with a financial expert. And if you like this video, make sure to hit the like button down below. And if you want to see more content like this, as I mentioned earlier, of course, do subscribe and hit the bell so you get notifications as soon as I post new videos. Thank you for watching, and I'll see you around.